Real estate is a little bit slow paced, right? It takes a lot of time, but now everything there is developing and it's just not going to stop.
How do you verify whether that's a safe investment or not? In the last few years, a lot of people have really gotten burned by inexperienced operators, or there's fraud and things like that in the space. But our job is to protect those investors, which means that all these deals need to be compliant.
Hello, everyone, and welcome back to the Path of Progress. I'm your host, Alex Kononov, and today we are diving into an exciting and fast evolving topic that's reshaping the future of real estate investing: tokenization. My guest is Tyler Vinson, an experienced real estate investor and CEO of REtokens, a cutting-edge platform at the forefront of digital real estate investing and tokenization. Tyler's been active in Pacific Northwest market, and now he's leading innovation with a blockchain-based platform that could change how we raise capital and trade real estate assets. Tyler, welcome to the show.
Yeah, thank you for having me. Excited to have the conversation.
It's great to have you here. Tyler, let's start from the beginning. Can you share a bit about your early journey in real estate? What was your first deal?
Yeah, so the way I got started is a good friend of mine, my best friend actually, had come home from college and he went to UW. He came and he said, "Hey, a couple of my friends, they are looking at investing in apartment buildings." And I thought that sounded pretty cool. So he took me to a local event. I've always been big on education. And so we went to a local event at a hotel, and it wasn't that great, but we signed up for it anyway. I went through the week course there, and we'll just say that it left a lot to be desired. So after that, he said, "Let's just go do it." And I said, "Go do what?" And he said, "Go buy some real estate." And that's exactly what we did. We went out and bought a duplex. It was a very interesting loan period where we lived, where we could put very little down and buy this non-owner occupied duplex. And of course, we learned everything we could from the guru. So negotiating at closing table, I think we ended up putting zero down on this duplex. And I think within a year we bought our second duplex. And that's really how it all got started for me.
And what year was that?
2002.
Love it. Wow. So you've been around for quite some time. People
Yeah.
really basically just scratching the surface with the first market correction, and you already have seen it all. So how was your first experience in the first few deals? Do you still have those properties?
I don't have those first couple properties. No. In fact, that very first one that I just described, the duplex, I would say we got scared out of it, within a couple of years, but we still made a couple bucks on our way out. And then the second duplex that we bought, we held for quite a few years and turned that as well. We were partners on those, and my partner decided that it wasn't really for him. We were doing a lot of the work ourselves and the management ourselves, and that was enough to kind of scare him out. So we ended up selling those, and I just continued it on my own and acquired some assets that I still own today. Yes.
Very good. So you tried on your first couple of properties, and what was your next on your real estate journey?
After that, I started getting into single family homes. I tried the flipping model for a little while, and I quit my job in the time that we did those first two deals and decided that I want to do real estate full time. And what that meant for me was getting my real estate license and trying to make an income that way while I built wealth through the investment portion of it. And I got connected with a real estate investment company that was doing lease options. They were kind of pre-screening these tenant buyers and getting them in a program. And then we would go out and find a house and I would put it under contract. And then I would sell it to the investors. They actually had somebody else, an investor manager that was in that position, that their job was to sell these deals to the investors. But in short order, they found that I was better at doing that. So they just had me sell those packages. And that's where I really started to learn about selling real estate deals to private investors, because private money and private investors have been a huge part of what I've done. In fact, besides maybe a handful of deals, I spent a decade after the Great Recession there in 2008, not using any bank loans, mostly because I couldn't qualify for them, at the time. And so seller finance and private money was something that I used through many deals throughout. So I did those first two duplexes, and then the real estate attorney I worked with, turned me on to one of his properties. That ended up being a lease option flip, and then that led to another property, and so on and so forth. So I did that for quite a few years, and then I bought those same deals that I was putting together for other investors in the lease option program. I started buying those and single family. And then in about 2010, I started getting truly introduced to the multifamily world. And by 2012, I started buying multifamily, and that's what I've mostly focused on up until today. Although I own a Class A storage facility that I bought and tokenized, I've owned office buildings and retail buildings, and I own some of that stuff today. But my bread and butter has been multifamily with creative finance and private investors.
It's very fascinating. Like usually people have a path of going traditional banking, acquiring 1 to 4 units and trying to get the loan, working the job, but you got all in right away. You couldn't qualify for the loan, so you have to go creative and tap into private equity, private money, and creative financing strategies, unlocking a whole new path for you to multifamily. Can you a little bit just tell our listeners what is lease option strategy and how does it work?
Yeah, so a lease option strategy is where you're going to buy a single family home typically, and you're going to lease it to somebody with the option to purchase. And the type of buyer that you're looking for is typically somebody that wants to be a homeowner but cannot qualify for a traditional mortgage right now. So instead of selling on owner financing and giving away the depreciation, you can do a lease with an option. And from a investor standpoint, what's nice about that is you normally get some option consideration up front, which is a non-refundable down payment, really. And then in these lease option scenarios, you're normally charging above market rents, and then you can choose to, and often is the case, credit some of that above market rent to a rent credit if they buy the home. So if they don't end up buying the home, then you will keep that option consideration or that down payment, as well as received a higher than market rate lease amount or rent amount the entire time. The other thing you do is you typically will choose a price. At least that's how I did it. So they had an incentive to work through, and that price is higher than what the market value is today. Do a 3-year or a 5-year lease option, and you increase the price. You take the non-refundable option consideration and then the higher lease amount. So there's a couple deltas or a couple spreads that you can make along the way. And the way I tried to set people up for success with it, of course, but it's still only about a 30% success rate. And so a lot of those houses, I would just do that same process over and over. And then sometimes it would be a great situation where the tenant could actually buy it out, and I was able to make a profit on the resale, make the delta on the rental amount. And the big part for me on the lease options was they were responsible for any increases in the taxes or the insurance and all the repair and maintenance that was involved. Now, I live in Washington State, and there's landlord tenant law where we had to execute some extra legal stuff. I would not do those transactions without an attorney involved. But in my scenario, they would execute a document, and they were responsible for repairs, maintenance, tax increase, insurance increase, all while paying an above market rate. And it did set them up nicely on the back end, because they normally wouldn't have to come up with a big down, because they had these rent credits and that option consideration that we would put towards a deal and try to get a win-win situation. So that's how I did the lease options.
I love it. Exactly what you said. You're creating a win-win situation. And for someone who's unfortunate with a bad credit or some life situation, they actually have an opportunity to be a homeowner. And you providing this opportunity, so they have 5 years to fix their credit, to qualify for the loan, collect a little bit more money, and at the same time they live in the house, and you introducing the home ownership in the equation. So you basically removing property management need in the case here, because there is no maintenance issues, because it's their home. technically until in the 5 years, so they're already taking care of it, and they love usually their home where they live, and they want to continue keep it nice and clean. So you just collect your rent check without any additional expenses, and it's fascinating. Okay, I like it. So you're very creative from the beginning, and it's very unusual. How did you learn about all of this stuff?
Well, some of it was by necessity. Like I said, I got into a position in the Great Recession there where I couldn't go qualify for regular bank loans, and so I ended up taking some education and mentorship from somebody that taught me how to write my own promissory notes and how to negotiate those promissory notes with seller financing. And then I had taken some separate, courses and education on private money and working with private investors. And that one was designed a little bit more towards a syndication, like what I've done more of late. But I was able to take that and kind of create my own model. There was a point in time where I had kind of come to a crossroads, August 2008, when all of my deals died. The market was dead. Banks wouldn't lend. The whole industry was in the toilet. All of us who were in the space remember those time frames. It was some markets, it was 2007. Some it was 2009. For me, it was August 2008 when the music stopped. And I had to come up with a business model with no money and no credit at the time, two brand new twins that were born. And, I had a third child and all my deals died. And all I did was real estate. So it was a tough moment. I had to come up with a model where I could, acquire real estate and make money doing it without needing to rely on banks or third party customers. And that's where I designed the model where, I knew I still wanted to buy real estate. I believed in it. And I had some people that knew me, liked me, and trusted me. So I was able to use that education that I had and go out and negotiate deals with sellers and then use private investment funds for the down payment to pay my own commissions and acquisition fees for the reserves and those type of things. And so I was literally putting better than zero down deals because I would get paid on every deal. I always made sure when I buy, I get paid. When I sell, I get paid. And then I started a management company in that process to get paid as on that service as well as the owner and getting the tax benefits, etc. with that.
Step one, get educated. Step two, take action. And I like you executed right to the T. So at what stage did you decide, okay, I'm enough with a smaller game, smaller multifamily residential. I'm gonna go to multifamily. What did made the change for you?
Yeah, I think, looking at when you do a single family home and you buy it and you improve it, you can then resell it or re-rent it for a higher profit level. And what I realized through doing some of the training and talking with others is you could compound that with multiple units. So why spend the same time and effort doing all of that on one house and only get the benefit of one unit when you could do it? One of my first projects was a 29 unit. And one of the first things I had to do was take out 23, ended up being 26 of the tenants in there and completely redoing that. But I made a strong delta or margin on each one of those units. And that changed the value of things completely. So it's kind of like a compound effect of what my efforts were doing, because those apartment building, houses are based on what the resale is going to be, what the comparable sales are. But multifamily values are based on what that net operating income was. So when I could increase the value of each unit, the net rent on each unit by $200 to $300 per month, that equated to a huge return on the back end when you talk about, say, cap rate or capitalization rate, what these apartment buildings tend to use as a selling metric. And so when I realized how that compounded over multiple units for a similar activity, that's when I fell in love with multifamily and kind of the art of repositioning those type of buildings.
And I want to add to our listeners who just a beginner in multifamily and just listening about it, like what is NOI? NOI is basically your gross income minus your expenses, and this is your operational expenses. This is your net operating income. And then later on, to get the valuation of the building, you get divided this net property income by the cap rate, which is known in the area of how much the property is trading in the area for this multifamily. So you get an idea. But also, it's another major point, right? It's not only income, but in expenses. You also, by renovating unit, you dilute a little bit the expenses side, and now it's not that expensive to maintain the property, so your expenses going down and your delta is increasing even more, not only by improving the income, but also decreasing expenses, and it's the beauty of it. I love it. Okay, so you went to multifamily, 28 units, and you started inquiring more about this multifamily plus. Are you trying still to increase your portfolio in multifamily? Are you actively buying nowadays in multifamily?
Yeah, I'm always buying at least a few $1 million worth of real estate a year. Maybe that's, one building or a handful of buildings. I do portfolios. I really made a name for myself locally by teaching sellers how to save on taxes by selling to me on owner finance. In fact, I wrote a book on that. So a lot of the acquisitions I did are buying sellers multifamily buildings, or often these are small multifamily portfolios where they've got like 3 buildings for 28 units or something like that. I've done larger buildings as well, but more recently in the last few years, it's been these smaller multifamily and multifamily packages. When interest rates were low and, everybody is out there with loose money, in my opinion, overpaying for a lot of the buildings, I just didn't care or need to get involved with some of the petitions surrounding that. And then, of course, back in 2021 and then certainly in 2022, I started changing my focus towards real estate tokenization and building out a company to help other investors. And that's where more than 90% of my time is spent today. But I still do buy, recently bought a small multifamily package this year, and we've even put together a fund to do some acquisitions in the back half of this year. So I'm always buying, but is become more of a, I guess, what you might call a side hustle instead of my main thing. But I have a sizable portfolio today that we keep and that we manage in-house and stuff like that. Like I said, storage facility and some commercial buildings as well as the multifamily stuff.
Keeps the lights on. But I like how you right now, guys. We go into uncharted territory. Well, we're going into tokenization, and you just mentioned that you just started switching your focus into this. How did you come even to the picture? What was a turning point?
Yeah, well, I've always had an underlying vision, even when I started, the real estate brokerage that I own as a small investment real estate brokerage. It was always to be able to serve investors on a larger level. Because when I got started, there was like 2 gurus out there teaching, Russ Whitney and Carlton Sheets, maybe Robert Allen, right? So I'm dating myself here. But there wasn't a whole lot. And they would teach particular ways to acquire property, and that was great. And then you would go to the attorney and they would have a different spin on it, and they're starting your LLC. And in fact, I remember walking into my first real estate attorney's office, and he says to me, I was 21, I think 22, 21, right in there. And he said, "So you want to be a real estate investor, huh?" And I said, "Yeah." He goes, "So you want to live poor and die rich, huh?" I was like, that doesn't add up for me. No, that's not what I want to do. So I think the fascination with all the different facets and rabbit holes of real estate became almost an obsession for me from that point on. Like even the question back then was, the gurus would teach you got to buy an LLC. And I went to my attorney, as I mentioned, and he did the LLC. So then I went to my CPA, and my CPA is like, "Well, I'm not sure about that. You may not want to do it that way." And then I went to my banker, and I said, "I want to get a loan in my LLC to buy real estate." And he's like, "No, there's no chance I'm giving you a loan in your real estate." So like just even those things and figuring out how to do that became really fascinating for me. And that has always been an underlying thing where I wanted to have kind of lower the entry barrier to be able to invest in real estate, I think has always been the ultimate goal. And so when I learned about tokenization, and what it was, instantly I felt like here is a vehicle to help me contribute to realizing this vision for everybody to lower the entry barrier. Because I tried teaching and I had done that, and it seemed like there's a very low success rate. I got into bigger deals and apartments and storage facility, and it seemed like I could only work with accredited investors. So there was a gap there. The actual turning point for me was twofold. One, as a professional real estate investor, and that's all I did, I constantly struggled with the illiquidity of real estate, where I would have millions of dollars of equity in real estate. And unless I sold the property in total, or went and wrestled the bank through a cash out refi, I could not access that capital, that liquidity. And when you're running a company or doing investments, or since that's all I did, that's part of my lifestyle was to spend some of that money. It was very difficult to get at. So I think a lot of professional real estate investors can relate. It's like, man, I just need a couple $100,000 to do this, and I've got millions here, but I don't keep that kind of liquidity on hand, or I don't want to, drain accounts down to that. And so that was a problem that I'd wrestled with for a long time. And then the other set of the, I guess, token, pun intended, was I was coaching my daughter's soccer game, and I came off the field, and a good friend of mine from high school, came up to me. She's like, Tyler, it's so good to see you. It's been so fun to watch what you've done in real estate and your success with real estate. She said, me and my husband have been working so hard, and we've saved up some money, and we'd really love to invest with you. And I didn't answer, and then she ultimately answered, and she said, but we don't have enough money, do we? And that was heartbreaking because it was true. At the time, the deals I had was a $50,000 minimum, and you needed to be accredited. And it just, something really struck me there. And it was like, okay, look, I've got a bunch of equity here. I'd love to have it be more liquid. I'd love to access this. She wants to invest, and I don't know how much she had, if it was 10 or 20, but I know it wasn't 50, and I know they weren't accredited. And I was like, there's a problem here. You can trade stocks, you can trade crypto, but you can't really trade fractions of real estate like that. And so when I got introduced to tokenization and being able to create digital fractions of ownership like that, I instantly knew it was the future, that real estate will trade the same as stocks and crypto. And I was very excited about it. And that's how I decided to take steps to enter the world of tokenization. I told my first folks that I met, I just said, I want to be a black belt in tokenization. I remember searching out this guy who at the time said that he did it. And he said, well, I don't think anybody's a black belt in it, yet. This is 5 years ago or what have you. And I just became obsessed at that point of, doing what I could to bring this to reality, where people could invest in real estate as easy as they can stocks or crypto.
You just unwired a little question for me. What is tokenization? But ultimately, it's a fractionalized ownership of the real estate. If we're talking about real estate, it can be anything, right? But in this case, you focus on real estate. So when did you start exploring this avenue? What year was that?
It was 2021, I think, when I really started devoting significant time and starting the first, entities to do this and entertaining, different partners. I do want to circle back just to simplify the definition of tokenization, because I do think that a lot of people, specifically in my industry, get so caught up in the tech side and needing to understand it and what does it mean and what's blockchain and all of that. And tokenization is simply this. When you create a real estate investment and invite other investors in, let's say like a syndication, you have normally an LLC and you have membership units, or you can call them shares, right? And that's what you sell to the investors, limited partners, so that they're part of that. Well, tokenization is simply making those membership units or those shares digital, giving them a digital component and putting it on the blockchain. That's it. That's what tokenization is. But to give you an analogy, real estate is kind of like a really, really large gold brick. And even though a really, really large gold brick is valuable and it's great to have, very few people can actually participate in owning that gold brick. There's a lot of barriers to do that. And once you're invested in the gold brick, it's very difficult to get out of that, whether you wanted to get your kids involved or whether you just wanted to get out of it in part, harvest some profits, you had a family emergency, whatever that is, normally you're locked into that brick. Moreover, whatever the sponsor or syndicator decides to do, sell the brick in total or maybe get a loan against the brick, everybody has to play ball that's in that brick. In fact, that puts a lot of pressure on the sponsor, the syndicator, to sell the project or cash out refi so their investors can actually realize liquidity and so that they could realize liquidity. But what tokenization does, it takes this big gold brick and now we're going to turn it into 10,000 or 10 million gold coins. And each investor who invests actually gets their gold coins and can hold them and can do what they want with them, whether that's sell one of them, whether that's invest in something else, whether that's stay put and do nothing. And so it just adds a whole new level of flexibility. And now with the secondary marketplace we're launching, it allows them to trade those, tokens for fiat, sell them, or obviously you could invest in other pieces of real estate as well.
I have a lot of questions. Okay, let's talk about technical side. And I know a lot of people skeptical about crypto tokenizations and mix those, sayings, but people don't realize that Bergen County in New Jersey, one of the richest counties in New Jersey, actually going on blockchain, on Avalanche blockchain, is getting tokenized. It was announced just a month ago, and it's a huge news because it's the first one. The whole county will be tokenized, which will streamline the closing period, verifications, everything's going to be on a blockchain. So tell me about your technology. On what blockchain are you building? Is it a specific one you chose for your development, and how did you do that?
Yeah, so we tokenize on the Polymesh blockchain, and the reason we do that is because it's a purpose-built blockchain for securities and for security tokens. It's called public permissioned, and not to geek out too much on this, but it means that all the node operators need to be regulated entities. So don't worry about it if you don't know what any of that means. It doesn't matter. But what you do need to know is that the blockchain was built for securities, because these are securities. The county that you just mentioned, I believe they're tokenizing the deed itself.
Yes.
Which is different. Yeah. So which will be a part of the tokenization future as well. But these are securities. So if everybody wants to just buckle up for a quick minute, I'll explain the difference there, and especially from a liability perspective. Should I?
Yes, absolutely.
Okay. All right. So when the deed is tokenized, like with the county, it's not necessarily a security there. And that's very interesting, right? Because you don't have all the other stuff I'm about to explain in a minute. You are just an owner in that deed and in that property. And that has its pros and cons. For example, one of the pros is you're attached to the actual, deed right there and don't have all the compliance issues because you're what's called a principal. The downside is if somebody slips and breaks their neck on the stairs, you are in that lawsuit. You have full liability exposure, right? Because you're on the deed. And there's ways to try to mitigate that, but the reality of it is you're not limited really in your scope when you're on the deed itself. And probably only so many people, at least in the early days, are going to be able to fit into this deed. What we do when we tokenize properties is security. So you need to have a exemption, like Reg D, 506C is a common one, or Reg A, but these are exemptions to registration. And I'm happy, there's a lot to potentially unpack here, so I'm going to try to talk high level, and then anything you want to deep dive, I'm happy to do that. But what we're typically doing with these real estate is creating that LLC I was talking about earlier, and people can invest in this in a limited fashion. Now, just because you invest in the deed doesn't necessarily mean it's not a security. I'm not giving any legal advice on this podcast or tax advice, but there's something called the Howey test. And if you invest with somebody and it, passes that Howey test or fails it, depending on how you want to look at it, that could still be considered a security. Meaning, if you invest with somebody and they're completely responsible for everything, you don't have to do anything, but you expect a return, that's typically going to fall into that security category. And so that's what we do. Everything that we do is SEC compliant. In fact, when we talk secondary market, I'll share some recent and exciting news that I haven't shared on a podcast before. So stay tuned for that. But when we create this LLC, it's a security and we find an exemption to registration and we sell pieces of those equity or those tokens. So when an investor buys into that, they're what's called a limited partner. So their liability is limited to just whatever their investment is, meaning if somebody slips and breaks their neck, they're not going to be part of that lawsuit. Their personal assets are not exposed. And to have that kind of safety as an investor and to be able to raise money that way as an issuer or a sponsor, there's a lot of legal compliance that has to be done. And so that's the security. So that's kind of the difference, high level, real quick, between the deed being tokenized and what happens there and a syndication, for example, being tokenized and what happens there.
Yeah, it makes sense. So, can you tokenize only new purchases, new properties, or it can be existing multifamily projects that's already ongoing for a year or more, and they guys decided to retokenize it so they can have more liquidity for investors?
Yeah, both. I mean, the primary reasons that people, tokenize today is either to do acquisition, development, or to recapitalize the project, meaning get liquidity out of it or get loans out of the picture. So we break that into kind of two marketplaces. One of them is called the primary market, where it's a security for the first time. We're going to raise capital for the first time under this, exemption. Then there's the secondary market, where they've already raised capital for it. So let's say that somebody did a Reg D a couple years ago, but now they would like to provide liquidity for their investors and themselves. They can tokenize that and sell those tokens on a secondary marketplace where both what we call the GPs or the sponsors can sell their ownership shares, and shareholder to shareholder or investor to investor can actually sell theirs globally to other interested and, in fact, non-accredited at that point buyers. So there's a primary when it's a security for the first time, and you're raising that to either acquire, develop, or recapitalize. And then there's a secondary market where you have liquidity to be able to trade. And the established projects out there that are illiquid, they'll do that to recapitalize and or to create the liquidity pathways for their investors.
So when you put properties in the secondary market, I know you don't have it yet, but it's coming. So what is the plan? How do you plan to live track the value of the asset? Because there should be some value for each token, right? So how do you reverse engineer the whole process? Is this a limited time period offering, or it's ongoing thing?
Yeah, it's a great question. So now I'll let the cat out of the bag. We've recently got our FINRA SEC federal approvals for the ATS secondary marketplace. So we will be the first SEC regulated secondary marketplace for real estate tokens. So we're super excited about that. There's other ones like T0 and Securitize, but they're not real estate exclusive. We'll be the first that's real estate exclusive SEC. And so, yeah, we are just within weeks of front facing this. Obviously, we have the technology and everything built out. It's a matter of just getting the state licenses here, which will take just a couple of weeks. And so the way that works is, so we have a broker dealer division now, which is SEC FINRA member. And what we do is there's a due diligence period or a due diligence process to get your project listed. So because they're securities, you also have to have an exemption to resell them. And so if only one person in the whole deal that's not the sponsor wanted to sell and list on an ATS, they can't really do that today. I mean, they could, but they would have to go through, they would need to be a significant shareholder because we have to get the deal approved. Because to sell to non-accredited investors, because you can sell to non-accredited investors on the secondary market, you have to abide by something called Rule 144. And just to go high level on that, it's a bunch of disclosure information so the investor can see like who was the sponsor on this, is there any recent financials, so on and so forth. But the way the sell is done is if you're going to list your token on there, you as the seller pick the list price of what that is, and then somebody can choose to buy it at that price. So you have the income coming in of how much is this making, what's the projected return, so on and so forth. And if I buy into that, that's the type of return I should expect, right? And you can choose to pay that price or not. You could make offers, to the seller to be able to do that instead. We don't have a market maker yet in this space. See, the way a lot of capital markets work today is you're not actually transacting with the other party. The seller's not actually transacting with the buyer. There's something that sits in the middle called a market maker who actually does the transaction. So you got like a bid and an ask price, and there's a little bit of a delta that's made by these market makers, and that allows for instant settlement. These transactions on our ATS can settle instantly as long as you have a buyer and a seller. But that's how it's going to work in the very early days here, is the seller will put their tokens up, and the buyer can choose whether they want to pay a price for that. Or the buyer gets on and they can look on REtokens and see all the different projects and what those prices are and decide, like maybe this one's, has a 4% cash on cash return and a 16% IRR, but it's a new class A, apartment building. Maybe another one has a 10% cash on cash return and an 18% IRR, but it's like a C class apartment building. And they can choose between those investors, or they could do both, right? 1,000 into this one, 1,000 into that one, or whatever they want to do. But they'll be able to click into the tombstone on each of those and see what the information and data is behind each of those investment opportunities.
You got my wheels turning. So tell me this. So as I imagine it as a platform, it's basically like a sell order. So the seller is the owner of the property. He put in a sell order. I'm selling this amount of tokens for this much. Take it or leave, whatever if you want to do. My question is, one property can have 1,000 of those tokens, right? There's, I don't know, not 1,000, but how many investors right now at the moment, and you fractionalize whatever they decide to. One investor can have, if it's 1,000 share, like 50 of those tokens, limited partner. So my question is it only main sponsor can put this on the platform, or the limited partner also can put his own price on this? So for example, if there's a property line, for example, apartment complex XYZ, and there's owner want to sell it his share for $5,000 per share, but one of the limited partners, he's okay to sell it for $4,700, and he can put it there also, or it's going to be only marked by the owner?
No, the limited partner can put their own price on the tokens that they sell. They have full control over it and can mark them at what they want. So as the market matures and develops, there could be some deltas to be had there, right? Some spreads to be had, and then, some certain pricing would average out. So, if a GP or a syndicator is putting it for a 4% return, and somebody can see the history of it, the cap table that somebody else has sold them at 8%, they may choose to hang back and see if somebody else would sell at 8%. But what will happen in the future, and it could be sooner than later, this stabilizes the market, is to have a market maker, or the crypto people know it as a liquidity pool. And that's where you're going to, the liquidity pool or the market maker is going to go ahead and buy the tokens from the sellers at a particular price and resell them at a particular price. And they underwrite those deals, and they know what the value is. If they know that buyers are willing to buy at 8%, then maybe they buy at 7% and make the delta, and that allows for seamless automated instant settlement of those transactions. So that's what will happen.
My mind is blown. Wow. And I don't think people really understand all of this, what you just said. Basically, guys, you can, I don't know if some of you trade cryptocurrency, but it's basically you go on and trade it. You want to, there's a price for each token at some mark, and right now it's trading at this like stocks, right? And at some point where there's a liquidity option available, you'll be able to trade it at stock price, like a stock price, and then there's no per se buyer yet, but it will be, someone will be able to buy it at the stock price, and it can go up, can go down, and then it will be trading like a stock. So crypto, did I get it right?
You did. Coinbase does that now. That's actually how Coinbase works, is they have a market maker. So if you read the fine print when you sell or when you buy, you'll notice that they buy your Bitcoin from you at a certain price, and then they resell it at, a market price, or they'll add a percentage to it, and they'll make that delta. So that's exactly how most of the stocks that are traded there. I won't get into how some of those transactions work, but we'll just stick to Coinbase for a minute. That's how Coinbase works. There is a transaction fee that they charge on each side, but there's actually also a delta that's being made to provide that liquidity, because they know what the market price is, they know what the buyer demand is, so they know what they're willing to pay for it, because they have a buyer waiting, at the next transaction for it.
How far do you think we are from this market maturity like this?
I think it's within 12 months because we're going to be working on it immediately. I think you really have to, get that in play as soon as you can, because if you're a seller and you're getting promised liquidity from tokenization and you list your tokens on there, how long are they on there? 1 day, 1 week? If you overprice them 1 month, I mean, you can certainly go change the prices yourself to attract buyers, because we got investor buyers who will be coming, and we've got liquidity strategies surrounding that. But it would be much better to just trade it like you do a stock or crypto today, where it's going to settle the same day for you, or T+1 in the stock market. And so what I like about real estate, and the reason I'm comfortable with that, is, let's say you're buying a building, or buying tokens into a building. I'm going to use cap rate just to try to simplify the conversation, put a general value to it. So let's say that, or I'll use the term return. How about that? That buyers all day are willing to buy these tokens at an 8% return. So when you do the bid, which is the buying side from the seller, then you're going to bid and buy at a 7% return. And real estate's very easy to underwrite in that capacity. You talked about NOI earlier. What's the net operating income? And you also mentioned that it has to do with cap rate. So it's pretty easy to evaluate those. Like every quarter at a minimum, it will get down to every month, maybe every week. They want every day, but we'll just say at least every quarter, the valuations are being updated, and really probably monthly, based on, the NOI. Every month you have a fresh NOI. And so what you can pay for that. And that market value could very well fluctuate with interest rates and things like that, just as real estate does now. We got to remember that the underlying asset is still real estate. So it's got all the pluses and all the minuses of real estate, but this is real ownership. You buy these tokens, you're getting a K1, right? You get the tax benefits, you get the capital upside, you get your share of the cash flow, and the technology has to manage all that. And that's where blockchain becomes very helpful. But that's why I think it will be within the next 12 months, is we feel comfortable. You've got to raise a certain amount of funds, whatever that is, anywhere between, maybe the first one's 10 million, maybe the second one's 500 million. It's going to need to be fairly large, but you're able to, there's ways that are done for liquidity pools where you make a deal with the sponsor of buying so many of their tokens from them, which gives them liquidity, but now you have that in your inventory. So as soon as a buyer comes, they can buy and they own it, and the seller's actually already sold it. There's some slight variations on how you do the market making in the middle, and I think that'll come within the first 12 months, because there's a good delta there, right? If the buyer's willing to pay 8% and you can pay 7%, and you're going to transact it fairly immediately, you're doing that all day long, and everybody wins across the board that way. That's how Coinbase does it.
Just look at the treasuries at a couple points and you know what market has, appetite for a large investor specifically. But okay, I wanted to unwind a little bit. I think it's important to mention that this will work very well for commercial real estate, because commercial real estate, like we discussed just now, it's on the road as a business, right? It has to produce income, has to have expenses. Now you have here a net, and you can get some idea of valuations. When there's stocks for big companies like Apple, Nvidia's, when their earnings going up or going down, stocks reacting, and people will understand. And if they have some dividends, it's also, this is correlation between business world and real estate. And real estate runs as a business. If you have bad business owner, the price will probably adjust. If it's underwater, the price adjusts and people won't buy it. It will stock. It will reduce the price because someone needs liquidity, and naturally the price will reduce itself. And now we're going to have open market, free market, where people actually can put their own price, and maybe, some people like sponsors attached to it, but limited partners, they have maybe their different vision. They consolidate with someone else and they think, okay, I need to get out of it, and they start reducing the price, and market seizes and reacts. And now we have really different game going on in terms of market and valuations and capitals. And I think will be much more fluid and exciting. It's very exciting. Okay, wow, it's moving much quicker than I expect. I thought you will tell me like 2, 3, 5 years we're gonna get there, like 12 months. Mind blown. How do you expect to find buyers to this? What are your goal to get user acquisitions as platforms? Because it's a risk for people to tokenize and stuck with it if there is no buyer pool. I understand there is a vision and there is, a lot of development going on in the space, but people are still skeptical about this. Let's be fair.
Yeah, there actually is no real downside to tokenization, because other than what it may cost you to get it broker dealer certified or the due diligence from a broker dealer listed. Because if you wanted to burn all the tokens and not have it be tokenized, you can do that at any point in time. You can still do all the traditional things you would normally do with real estate. It doesn't put any limitations on what you're doing there. So I think that's a misconception that people have, is like, once you tokenize that, you can never go back, and that's the way it is. There's projects that we tokenize that nobody wants to sell. They don't do anything. They can, they're available to do that, but nothing changed. Like, I tokenized my storage facility and I had to talk to my LPs and let them know what I was doing. And they're like, well, oh my gosh, what's going to happen? What's going to be different? How do I get paid? What is all that? And I said, actually, if I didn't tell you, you wouldn't even notice. You wouldn't notice. It operates the exact same way. Now, if you wanted to trade some of yours, you'll notice. If you want to get paid in a different way, like you would notice. But there's really no downside to that. I even get asked a lot by, what do mortgage companies think about this, and how do they look at that? And in fact, I was having breakfast with my banker and was telling him about this, and it was all news to him. He's like, well, wait a minute. What's going to go on with, when ownership changes, we're going to have a problem with that. And I said, well, in a regular real estate syndication, do you have a problem when ownership changes if it's under 20%? No, 20% or more. I said, okay, so same, right? Same thing. Somebody would have to own 20% or more of the project before the bank has any concern with beneficial ownership, just like traditional real estate does. But if somebody's trading 5% or 10% of a total project, which is normally a pretty huge amount, actually, the bank's not going to have any issue with that. Well, I'm not sure if my lender will be okay with this. Is your lender okay with real estate syndications where you have a sponsor and maybe there's a guarantor or not, depending on if it's secured or not by them? Or do they have any reservations with you selling equity pieces to other investors? Again, there's a 20% threshold there. So the other thing is, like, people will bring up regulation surrounding it. I'm not sure if there's clarity surrounding regulation. Well, that's more of a crypto thing. We already came out and said these are securities. There's no question that you have to find a regulation exemption or be registered with the SEC. And us as a broker dealer and as a platform, that's one of the most significant things that people don't realize of what will make this go round is these are regulated securities. We're a regulated marketplace. So investors coming to buy, when you go invest in a real estate project, how do you verify whether that's a safe investment or not? And in the last few years, a lot of people have really gotten burned by inexperienced operators, or there's fraud and things like that in the space. But in our marketplace, these are all vetted by an SEC regulated company and a SEC regulated marketplace. Our job is to protect those investors, which means that all these deals need to be compliant. And that's a big part of what we do, because it keeps the issuer or the sponsor out of hot water. It keeps them out of trouble. They can sleep at night. And there's just a better way to do this business, right? And it does require regulation, and it was a huge lift to get to where we are, but it's a common ground where people can feel safe about investing, and syndicators can feel confident that the way they're raising capital or the way they're selling their securities, their equity, is in a compliant manner, that they're not getting in trouble. In fact, we can program that compliance features into the tokens themselves.
So you unpacked just a lot of information, and it's very interesting. But tell me this, do you have some guidelines on your website, if it's a first raise main channel, that sponsor cannot sell more than specific amounts? They have to retain some ownership of the building, because the sponsors, loan guarantors, their asset manager, you need to have some skin in the game, right?
Yeah, so we don't allow more than 90% to be sold, meaning the sponsor must maintain a minimum of 10%. And if we
Okay.
underwrite the deal and figure for some reason it needs to be more of that, then we would, do they have a succession plan or not, et cetera. But 10% is the short answer to your question.
But if there is someone else willing to step in into sponsorship shoes, there's also ability to transfer those tokens if it's vetted, right?
Yeah, there's going to be legal disclosure, et cetera, involved at that point, probably more than we want to get into. Because people need to know what's going on, even though they're limited partners and they don't necessarily have a say in the project. If it can materially affect their investment, then they need to be notified, and it may be structured where they can actually even vote on that. But again, the simple one right now is a syndicator or a sponsor is going to need to stay in the deal at least a minimum of 10%. And if they wanted to exit in total, then they would just sell the property as they normally would, and everybody would get paid out on their pro rata ownership. It's because you can still sell the whole property anytime you want, right?
Yeah. And now back to your platform. So for the first time raise, are you planning to develop crowdfunding arm as well, or you just provide merely tools for sponsors to use your platform for the crowdfunding?
Yeah, so we're right in the middle of making that pivot to where it's been more of a do-it-yourself, because these are securities and we weren't a licensed broker dealer. We didn't have that division. So we provided a playbook, an accredited investor playbook on how to raise capital. And then, of course, we provide the software to be able to do that. We have cap table management, so that it manages who owns what within the tokens and cap table. That's going to be really important in the secondary market. But that now has switched to where, as a broker dealer, it's much more of a white glove service as far as the capital raising goes. We can participate and get them connected, and we bring the investors in through our platform. But everything's integrated in the platform, so investors can invest online 24/7, 365. They have to go through something called KYC, which is Know Your Customer. They got to do that in any circumstance. And then accreditation, if it's like a Reg D 506C, or you have to be accredited to invest in this primary, like you're talking about, accreditation's built right into there. And then in the secondary market, they will only have to do KYC, because you don't have to be accredited to invest in the projects that are on the secondary market.
Yep. Okay. And who do you think will be the primary customer here on your platform? Is it regular real estate investors like myself and you, or more like institutional investors?
We're built at an institutional level, so we can certainly handle the largest of investors. Where we're seeing most on the syndicator issuer side are larger syndicators that have, typically they have multiple commercial projects, apartments. One of them is going to be a huge housing development in Colorado where they're going to have 2,500 lots. We've got another industrial flex project in Colorado. We've got apartment buildings. We've got hospitality developments where they're actually putting perks and utilities into the ownership tokens themselves, which is kind of cool. So these are going to be, I would say, regular to large syndicators. Now that we're a broker dealer and we can play at a bigger level and participate in the fundraising. So if I put a line on it, I might say that they have at least $10 million of assets under management, which is kind of a low floor in the syndication world, because this is about being able to scale a brand on the syndicator side. Normally when you raise capital, you're stuck to, whatever your network looks like, whoever your contacts are, and then whatever marketing efforts you do alone. But now you'll be able to raise capital in a global marketplace and rest assured that it's compliant. So those are the issuers, is larger syndicators who really want to grow their brand, who want to expand their investor base without the headaches, because the technology, in fact, there's AI embedded in it that could answer questions. It's custom trained to each deal. So it really takes a lot of the heavy lifting out of having multiple investors in a deal. Gone are the days of having to email documents back and forth, having to get on one-on-one meetings, taking calls directly. So much of that is automated. So that's where we see it. The folks that want to tokenize, they either want to create liquidity for their project. So they want to either take some equity out or allow their investors to be able to sell equity, or maybe they want to pay off a loan because they have one of those commercial loans coming due and rates are really high, or they can't get a new loan. It's not going to work at an 8% bank rate, or maybe the debt coverage ratio isn't there anymore, but it's still a good project. It's just going to kick off a 5% cash flow for a while, but it's still going to be fantastic in 3 years while they can raise that capital, get the banks out of the picture, or as I mentioned, acquisition and development. Over on the investor side, yes, regular LPs who invest in real estate syndications today, this is their dream, because now they can go to a marketplace. They have a wide variety of selection. They know it's an SEC regulated marketplace. So diversification becomes easy. There's very low entry barriers to be able to invest in those, and they can go through that process to get, and I think family office is starting to sniff around it a lot as well. So those are even bigger checks. As we're able to standardize what we're doing, and being a broker dealer and SEC regulated marketplace will help this. They need to be able to buy from an SEC regulated platform. Institutions need to have all of those safety measures in place for all of the people that they serve. So I think that that's probably down the road a little bit. But the biggest appetite out there that people are underestimating for investors in liquidity is your regular Joe and Jane investor who would love to invest in real estate, but has never had access to my commercial building or your apartment building. They've never been able to get, especially for $3,000 or $5,000 or whatever it is, or to be able to dollar cost average into it, or to be able to, buy in different states and across these. They've never had access to it. So that's where we've found the largest appetite is in the retail investor, and specifically the non-accredited retail investor. Now, they don't write as big of checks. That's true. But their appetite and their numbers are billions and billions of dollars worth of liquidity that we are going to open up to the marketplace. So that's another reservation I get, or a question I get is, well, what's that secondary marketplace really like? Is there really liquidity out there? And look, this hasn't existed before in this manner. So I'm not going to overpromise, and there's not market makers like we talked about earlier. I'm not going to say, if you list, there's going to be a buyer there, that afternoon to be able to buy that. There might be. There's buyers there coming every day. So there may be, but we don't want to over promise that. But as we get more assets on platform and people understand it is a marketplace that they can go buy these vetted investments, you'll see that continue to grow. Moreover, it's a global marketplace. So now that we're getting in position to put some marketing dollars behind it, that is going to see billions and billions of dollars of liquidity. So the liquidity ladder looks like this: retail non-accredited investors, or you could group them in with retail non-accredited and accredited. The accredited are going to write bigger checks. They're used to doing that. But the retail investor, then you have the family office, or, there's real estate funds. Quick example. I had a meeting last week. A gentleman called, and what he does is he runs a group of 40 fund managers. And all of these fund managers have real estate funds that people invest into. These are called LP funds, or limited partner funds. And what they do is they look for real estate syndications to invest into. That is what they do. And the person who runs that fund is kind of the one that underwrites the deal and makes sure. But people that don't have the time and energy to find all these real estate investments can invest in one of these real estate funds, which invests in these real estate projects, right? So this gentleman is very excited for us to get the assets on platform because they want deal flow. Now, all 40 fund managers, which is more than 40 funds, are all looking for us to bring assets on platform so they can take their fund and start buying into these different real estate deals. That alone is going to create hundreds of millions, if not more, just that one group of liquidity. And there's many, many of those types of groups in the US. And then when you take it global, it's a whole new thing. So it will take some time, right? People need to look, they need to understand, they need to be made aware of it. But once people realize that with a few clicks of the button, they can choose to invest and be a real owner in some of these real estate assets, it's a wildfire waiting to happen.
Absolutely. Wow. This is a new twist, definitely. Going to the fund managers, and yes, they have lots of capital sitting, they're looking for the deal. In the meantime, they're looking for their own deal. They can go into your platform and invest that sitting capital and produce even more revenue for their investors. It's a very new twist. Anyways, going back to smaller investors, you said you can fractionalize as much as you want, as much as the ownership wants of the property. How do you see it's been managed for the tax perspective? You said everyone gonna get K1, so thousands of K1s will flow to the all investors. Do you see this manageable?
Not the way it's traditionally been done, absolutely not. But this is where technology and blockchain comes in and solves the problem. So when you run a syndication or an entity, there's an LLC, an operating company that's going to file a tax return, right? And all of the investors that are invested in that entity, and that we'll call it an LLC, get something called a K1. So they get their pro rata of tax depreciation. It shows income wise what it was. And ideally, the reason we invest in these things is the amount of money we put in our pocket should be more than what that K1 shows, right? There's all sorts of cool strategies surrounding taxes that people use in real estate. Well, as a real owner, you get to benefit on that. But the point is this, is the CPA does the single tax return for that entity, be it a building or be it a company that owns a few buildings. That doesn't change, right? You still have a single CPA doing the tax return. What does change is normally that CPA is doing something to create these K1s and having to send it out to all those individuals. Well, now there's software out there where you can take that tax return, put it into the software. It knows based on what we call an address, or we'll just call it a digital identification, who owned the token for what days of that year, and can automatically send out those K1s. So you can own it for 1 day and you'll get a K1 for that 1 day. You could own it for 2 months, you'll get a K1 for that 2 months. You own it for 12, so on and so forth. But it's that single data source of the tax return, and that data is entered into the software. That software can verify who owned those tokens for which days of that year and disperse the K1s accordingly.
Because a keyword is still a blockchain, right? Everything is in the blockchain. So you will see verifiable ownership to the day and a minute when they got honored. And it's like Etherscan, right? But it's going to be for Polymesh, and you'll be able to offload all the information out there and provide it to your CPA to get the most detailed information on who's owner and when.
Yeah, it's true. We keep a cap table in the software, which is really, that comes from something called a transfer agent. A big part of what we did as a company was connect all these things that nobody really wants to hear about because they're complicated to make it work with a few click of the buttons. An example would be you have to have a transfer agent to switch an LLC ownership or a share from one person to another. Right? And then who custodies these things for the trust of the transaction and all that? Well, our platform has integrated all of that to make it all work with just a few clicks of the buttons. Yeah.
Makes sense. Simplify it, and then everyone will come to use it. So, are you operating nationwide? It doesn't matter for you where's the property located, or are you still limited to some states?
Well, as far as properties that we can tokenize anywhere in the world. We don't have any boundaries for that. Now, internally, there's some questionable countries that we probably would not entertain tokenizing in. One of the things is because you got to understand that each jurisdiction has its own rules. So what are their rules surrounding property ownership? If those aren't really clear, then I'm not sure that that's a project. Property rights, how do the property rights work there? So we're going to look at those types of things. Plus, if the issuer or the sponsor can't make it through KYC, like if they're on the terrorist list or a Russian oligarch or something like that, then they're not going to be able to participate either. Most of the limitation is surrounding on how the capital is raised and selling to, investors. That's where some of these licenses, I think, become a little more important because, again, the reality of it is the SEC is out there to protect the investors. And so, as mentioned earlier, not only do we have the federal licensing, but now we're in the process of getting licensed in every single state to be able to do business there. But, on the secondary market, there's something called a Reg S, and if you want to, we can get into that, but there's all sorts of complications surrounding that in a primary rate. A Reg S is a foreign investor, a non-U.S. investor, and they don't have to be accredited. So people find that appealing, but it's kind of complicated in a primary raise. In a secondary market like ours, you just have to go through KYC, and you can be from anywhere in the world to be able to invest in those. So it's very much a global effort here with some limitations based on terrorist states, etc.
And I think you mentioned this before, but I want to again mention it to our listeners. If the property was sold originally for credit investors, after some period of time, when it go to secondary market, it can be sold to anyone. And I think this is a very intriguing point, that now your pool of investors increasing immensely, and it just sky's the limit, and your appetite of your potential investors can be much bigger because there's a much bigger pool of people who want to invest 3,000, 5,000, 10,000 into property that they won't be able to do it before because accredited has such a high limit for regular blue collar hardworking people in America.
Yeah, and there's really a delta likely to be made there, a spread, an additional profit, because real estate has something called an illiquidity discount, meaning the reason real estate normally has higher returns is because it's been illiquid. You haven't been able to trade it, to where an accredited investor might come in and say, hey, I need 8% or 10% to consider it because I can consider all these deals. A school teacher, firefighter, or the server at your favorite restaurant may be willing, and is, I've talked to them, willing to take a 5% return for real ownership of the real estate, real appreciation opportunity, real cash flow, real tax benefit, right? Because they can't go get that anywhere else. They don't have access to that. So if you, let's just use cap rate for those of you that really understand commercial real estate. If you would normally list it on the marketplace at a 6 cap, but you can go sell it on the secondary market to a non-accredited investor at a 5 cap, that is a major profit margin that's made simply by adding that liquidity component, by tokenizing and be able to sell to a non-accredited. And the non-accredited still wins because they actually get an opportunity now to participate in an investment like this and still get a strong return, to where their only other options right now may be the stock market or crypto, right? And real estate's a very different asset class than those two.
I think we will see real estate sitting on a not listed on the market for a long time, with ownership not changing the hands in a traditional way, but in tokenized way. So we won't see properties selling for 30 or 40 years or 50 years. But when it comes to market, who are invested in tokenized, on top of their return, everyone who is tokenized will get return, and they buy in specific return. But if the market is ripe and the main sponsor decides, okay, this is a great opportunity to sell this property in a great profit, then those people can get additional return on their funds and maybe reinvest in more properties.
That's right.
I love it. Tyler, I think we already closed it to our timeline, so I have last few questions for you. Quick hits, lightning round. One book or resource that shaped your mindset as a business leader?
It's got to be Think and Grow Rich.
Makes sense. Most important trait for someone launching a real estate startup or investment firm?
Mindset, and I know that's a little bit of a cliche answer, so let me unpack it a little bit. You are going to have highs and you're going to have lows. You're going to get some yeses and a lot of no's. And you have to have belief in what you're doing to progress through that. You have to visualize what the end game looks like to get there. If you go through with doubt and uncertainty and live in that world, then you'll eventually stop and quit. And so the mindset is critical, that you believe in the end outcome, and it's funny how it can become reality. The other mindset has to be a growth mindset. We talked earlier about education. In my early days, to this day, I'm relentless about educating myself, right? As Tony Robbins says, you get paid for the value that you bring to the marketplace. So the more that you educate yourself, what you're educating is how you can provide value to what you're doing, and people pay for that. So if you have that don't quit type attitude, and you back that up with relentless education, and then believe that it's to happen for you, ultimately it's inevitable that it will. And that's critical in a startup when you are going to get your teeth kicked in sometimes.
I think it's a lot about open-minded and being focused. You have a target. If you don't have a target, you're never going to hit it, right? You don't have it in mind or on the wall. It's just never going to happen because you don't know where to throw your dart. It's a path without the end. But also being open-minded with this world, that's everything's changing every day. In the blockchain industry, in real estate. Real estate is a little bit slower pace, right? It takes a lot of time because it's a big elephant. But now we have this new guy on the block, crypto and a blockchain, and everything there is developing. AI, again, developing. 5 years ago, we didn't know what it is, and now we just use it every day, and it's just not going to stop.
Right. Yep.
So, okay, last question. One thing you wish you knew earlier in your investing journey?
I think just the matter of consistency and how important that is. I think as entrepreneurs, we tend to get ramped up, especially if we need to make some money. And then, we get fed or do a deal and our marketing falls off, right? Or our capital raising falls off. And then we're back kind of running at it, again. And so I think I'd often say the two most underrated success principles is, number one is consistency, and right behind that is preparation. So I think they really go together. So I that's kind of what I would redo, is just develop things to be a little bit more consistent instead of up and down sometimes.
And specifically on persistence, every time you get kicked, you have to stand up. That's what it matters. Stand up and keep going to your goal, to your targets. That's what matters in the end of the day.
Yeah, it is, because What that means to me is keeping the commitments to yourself. The most important commitment you can keep in life is to yourself, because not only is that going to build confidence when you keep the commitments to yourself, but it's going to stack evidence of who you really are and who you can be.
I feel like we can talk about mindset a whole another podcast and
Yeah.
talk about tokenization even more. There's so much to unpack, and we will have to redo the session again after you have your secondary marketplace up and running. I would like to hear more about it.
Yeah.
But for today, I have one last question for you. If someone wants to learn more about REtokens, your company, or follow your work, where's the best place to find you and connect with you?
Yeah, education's important for us. So I would start with the website, REtokens.com. In fact, for the listeners, they can go down and for free download a quick start guide to real estate tokenization. So I highly recommend that. Just go to REtokens.com and you'll be able to download the quick start guide to real estate tokenization. If you want to connect with our company or our page, we share a lot of insight on LinkedIn. So that's just going to be REtokens on LinkedIn. And if you get really interested and want the educational stuff, we've got a great YouTube channel. It's just at REtokens, where we talk about not only the issuer sponsor side of tokenizing real estate, but we also talk about how to evaluate the investment options for tokenized real estate. And those would be the three best spots.
Tyler, great. Lots of knowledge. Thank you so much for coming in today. Thank you for sharing your story. It was incredible, your insights and glimpse into the near future of real estate investing.
Yeah, I appreciate you having me on, Alex, very much so, and look forward to our next conversation.
Absolutely. And to our listeners, if this episode opened your eyes to new possibilities, don't forget to like and subscribe and share with someone who needs to hear about this. And as always, keep moving forward.